If you've ever felt like investing is too complicated, too risky, or something you need a ton of money to even get started, you're not alone. Maybe you've tried, maybe you've waited, or maybe you've just been stuck wondering where to even begin. The truth is, you don't need to be perfect, and you don't need to be rich. What you do need is a plan, and this guide is designed to help with just that. Simple, smart, and beginner-friendly. In this video, I'll walk you and John through step-by-step how to approach dividend investing in 2025, even if you're starting from scratch. We'll cover what dividends are, how they work, why some investors choose this type of strategy, and common beginner mistakes that you'll want to avoid. In the end, we'll also look at a hypothetical example of how consistent investing might add up over time. For instance, if someone invested $7 a day and reinvested dividends, under certain assumptions, that portfolio could grow to over $1.7 million after 30 years, potentially generating around $5,000 per month in dividends. So if you've ever asked, where do I even begin? The answer is right here. Let's get started. So what exactly is a dividend? In the simplest terms, when you buy a share of a company, you own a small piece of that business. And some businesses, when they make profits, choose to share part of those profits with their shareholders. That is called a dividend. It's the company's way of saying, hey, thanks for believing in us. Here's a cut of our profits. Most dividends are paid every 3 months, and they show up as real cash in your investment account. You can use that money however you want, reinvest it, pay a bill, or just let it sit. It's yours. Some companies even pay monthly dividends, which can feel like a second paycheck if you build a big enough portfolio over time. But here's where it gets even better. Some companies not only pay consistent dividends, they actually increase them year after year. So the longer you hold, the more income you get. That is called dividend growth, and it's a massive deal for long-term investors. Over time, this creates a snowball effect. Your dividends buy more shares, which pay you more dividends, which buy more shares, and on and on and on and on. That is compound growth, and it's one of the most powerful forces in investing. More on that coming up later. Of course, not every company pays dividends. Tech startups, for example, usually invest profits into growth, but stable, profitable companies like the ones we'll talk about in this video often pay dividends like clockwork. And it's not just individual stocks. There are also ETFs, bundles of dividend-paying companies that make it even easier to get started. So in short, dividends are simple, reliable, and powerful, and they're the foundation of wealth building. Now, before we talk about accounts, apps, or picking stocks, the first step of every investment is setting your mind straight. Have a clear goal of what you're getting into. Dividend investing isn't just a financial strategy, it's a mental one. This approach isn't built for excitement. It's built for results. You're not chasing quick wins. You're building something slow, steady, and unshakable. Think of it like growing a tree. You plant the seed, water it, protect it, and one day it grows tall enough to give you fruit every season without asking for anything back. That is what dividend investing is. It's long-term wealth in the making. The problem is that most people quit too soon. They buy a stock, wait a few months, don't see any fireworks, and assume they're doing something wrong. They aren't. They just didn't give it time. Listen, if you treat this like a get-rich-quick scheme, it will disappoint you. But if you treat it like building a money machine, it'll change everything. You'll need patience when results feel small, and discipline when things get boring. But even small investments, $5 here, $10 there, stack up over time, especially if you reinvest your dividends and let compounding do its thing. This mindset shift is everything. You're not trading. You're not gambling. You're owning assets that pay you over and over again. And the longer you stay in the game, the more you win, not just in dollars, but in confidence, peace of mind, and financial independence. So as we move forward, keep that perspective in your mind. You're not trying to win today. You're building something that lasts 10, 20, 30 years. Okay, so now that your mindset is in the right place, let's move on to something more practical. Step 2, the actual account that you'll need to get started. To buy dividend-paying stocks or ETFs or any stock for that matter, you need a brokerage account. Think of it as your personal investing dashboard. It's where your money lives, grows, and starts working for you. A brokerage account lets you deposit money, buy stocks, receive dividends, and reinvest them all in one place. It's simple to set up, and you can start with any amount. We've teamed up with Moomoo. In fact, quick shout out to Moomoo sponsoring this video. If you've been investing through your bank or one of those bare bones apps, this might be a good upgrade for you. Moomoo is a free platform that gives you real-time market data, advanced tools, and zero commission trades, all in one clean, easy-to-use app. In fact, new users right now can get up to $1,000 in NVIDIA stock just for opening an account and making a qualified deposit. And the more you deposit, the more NVIDIA stock you can earn. It starts at $20 for $100 and goes all the way up to $1,000 in stock if you deposit $50,000 in your account, which is on top of their usual promos. You still get 8.1% APY on uninvested cash, and yes, that cash is FDIC insured up to $1 million. You also get free access to Morningstar research, analyst ratings, and premium news sources like the Wall Street Journal and Bloomberg. So if you want to check it out, the link is in the description and pinned comment. And even if you're just curious, the promos alone make it worth a look. Thanks again to Moomoo for supporting the channel. Okay, so you're Moomoo'd up. And now that you have a brokerage account ready, the next step is to learn how to pick good dividend stocks and avoid the common traps that many beginners fall into. Here's the truth, not every stock that pays a dividend is a good investment. Some are incredible long-term wealth builders, others look attractive on the surface but can quietly drain your portfolio if you're not careful. The goal isn't to pick the stock with the highest dividend yield or the fanciest name. The goal is to pick companies that can keep paying you year after year while steadily growing over time. So how do you tell the difference? Start with the dividend yield. The yield tells you how much income a stock pays in relation to its price. If a $100 stock pays $3 a year, that's a 3% yield. Pretty straightforward. But here's where beginners mess up. They chase the highest yield they can find. You'll see a stock offering 10% or 12% and think, well, why bother with a 3% stock when I can get 4 times more? And that's the trap. Usually, a sky-high yield means the company is in trouble or the payout isn't sustainable. Many of those companies cut their dividend eventually. The stock price crashes and investors lose money. A healthy dividend yield is usually somewhere in the 2% to 5% range. It might not sound exciting today, but it's reliable, and reliability is everything. The next thing to look at is the payout ratio. This is how much of a company's profits they're handing out as dividends. If they're paying out almost everything they make, there's little room to reinvest back into the business or handle tough times, so that's a red flag. Imagine a friend who makes $5,000 a month but spends $4,900 of it. Sure, they're paying their bills now, but one unexpected expense and they're in trouble. Companies that pay out too much can end up cutting their dividends later. Ideally, you want companies with payout ratios that leave room for reinvestment and growth, not ones giving away every dollar just to look good on paper. A good payout ratio is one that's below 60%. Then there's dividend growth. This is where the magic really happens. Some companies don't just pay dividends, they actually increase them every single year. It might start small, but when you look back over 10 or 20 years, the growth is incredible. Imagine buying a stock today that yields 3%. Over time, because the company keeps raising its dividend, you're eventually earning 8 or 10% or even more based on your original purchase price. That's called yield on cost, and it's how patient investors end up with massive income streams from what looked like boring stocks in the beginning. A company that has a history of raising dividends even during recessions is the kind of partner you want on this journey. And finally, don't forget the obvious. Look at the strength of the actual business. A dividend is only as safe as the company paying it. Is this a company making consistent profits? Do they operate in an industry with long-term demand? Will people still need what they sell in 10, 20, or 30 years? That's why consumer staples, banks, healthcare, and utilities are so popular among dividend investors. They provide things people use no matter what's happening in the economy. This is important because flashy startups or highly volatile businesses may not be the best choice if your goal is steady income. Now, the mistakes most beginners make all come down to these same points: chasing sky-high yields, ignoring payout ratios, focusing on today instead of the future, or buying businesses they don't even understand. A dividend stock should feel boring, not risky. If you can't explain how the company makes money, you probably don't want to rely on it for income. The thing is, you don't need to find the perfect stock. You just need to avoid the obvious traps and stick with high-quality companies that reward their shareholders year after year. If you do that consistently, time will do the heavy lifting for you. And that brings us to step 4, which is building your portfolio. Now that you know how to spot strong dividend stocks, let's actually put together a simple but strong dividend portfolio. Think of this like building a house. Every house needs a strong foundation first, and then you can add the walls, the roof, and the details that make it stronger and more unique. For dividend investors, that foundation is often an ETF. If you were building a standard investing portfolio, you might start with something broad like an S&P 500 index fund. But since we're focused specifically on dividend investing, the best place to start is with a dividend ETF. And one of the most popular and my personal favorite for beginners is SCHD, the Schwab US Dividend Equity ETF. Why? Because SCHD is like a basket filled with dozens of high-quality dividend-paying companies. It's low-cost, beginner-friendly, and historically strong in both dividends and growth. For most new investors, SCHD alone is a solid first step. But to take things further, you can layer individual stocks on top of that foundation to add both stability and growth. Let's look at a few examples. JP Chase gives you exposure to the financial sector with one of the strongest banking brands in the world. They've proven themselves through multiple market cycles, and their dividends have been reliable. AbbVie comes from healthcare. With products people use every day and a strong pipeline of future drugs, AbbVie combines both income and growth potential. Lowe's is a retail giant in home improvement. It might not sound flashy, but the demand for housing and renovations never really disappears. Lowe's has one of the most impressive dividend growth histories in the consumer sector. And finally, NetEase gives you exposure outside the U.S. It's a Chinese technology company with strong growth and an excellent record of rapidly increasing dividends. This adds a little global diversification and the potential for higher dividend growth. Together, these picks serve different roles. SCHD is your steady foundation, JP Chase and Lowe's are your stable U.S. blue chips, AbbVie gives you a higher yield and healthcare exposure, and NetEase adds international growth potential. This way, you're not putting all your eggs in one basket. You've got diversification, stability, and growth all in one simple portfolio. And if you're interested in the investing metrics of these stocks, here's how it looks with each individual holding's current dividend yield, CAGR, and annual share price appreciation. The next step is to calculate your overall portfolio's metrics. And let's start with dividend yield. We'll keep it super simple. Since we're investing equally across all the picks, all you have to do is just add the 5 dividend yields together and divide by 5. Using your numbers, 3.73% plus 1.93% plus 3.18% plus 1.87% plus 2.26% equals 12.97%. Now we divide 12.97% by 5, and that comes to 2.594%. Rounded to 2 decimals, your portfolio dividend yield is 2.59%. You can use this exact add and divide by 5 approach for the other metrics too. So for your data, the portfolio's 10-year dividend growth rate is 15.57%, and the portfolio's annual share price appreciation is 13.99%. Great, you've built your portfolio. Now the big question is, when the dividends start coming in, what do you actually do with them? Well, you've got 2 choices. The first is to reinvest your dividends. This is called a DRIP, Dividend Reinvestment Plan. With DRIP turned on, every time you get a dividend, it automatically buys more shares of that stock or ETF. And those new shares will then earn their own dividends. This is how you build the famous snowball effect. It might start small, but over the years, that snowball grows into something massive. The second option is to take the cash. Instead of reinvesting, you can withdraw it, use it to pay bills, or even treat it like a second paycheck. Many retirees use their dividends this way as income they can rely on every month. So which is better? Well, if you're just starting out, reinvesting is usually the smarter move. You want your snowball to grow as big as possible. Later, when your portfolio is much larger, you can always switch and enjoy the income. All right, so we've built the portfolio and figured out what to do with the dividends. Now the exciting question, what does this actually look like over time? Well, let's say you and John invest just $7 a day. That's about the cost of a coffee and a snack, or a streaming subscription you barely use. Instead of spending it, you put it into your dividend portfolio. After just 1 year, you would have contributed $2,555. Yeah, your portfolio is small, but it's alive, and this account sets the stage for future growth. Fast forward 10 years, and that tiny daily habit could grow into $56,758. If you stay consistent for 20 years, the portfolio could reach $336,697. And if you keep going for a full 30 years, the results could become life-changing. That simple daily $7 has the potential to reach $1,791,816. The dividend income alone could be about $61,840 every year. That's $5,153 arriving in your account every single month, whether you're working, sleeping, or traveling. The growth comes from two engines working together. About $1,350,244 is from the stocks themselves appreciating in value. Then another $364,922 comes purely from dividend reinvestments, money that bought you more shares, which paid you more dividends, which bought you even more shares. That is the compounding snowball effect in action. Click the video on the screen to find out how to make $7,000 per month with only $20 a week.